we are going to get into kind of what I've nicknamed or put together as a title, Smart Seller's Playbook. So, option selling strategies with the built-in protection that is a great way to go. So we'll kind of go through this 7-step plan for your option trading success. And that being said, let us get rolling. So a little background on myself. I started out my trading journey back in the 80s and was fortunate to get in with a company called Coastal Corporation. They were, pretty large integrated oil company that had refining and, kind of oil distribution, a lot of transportation for oil and pipelines, things like that. So they were actually at that time, back in the early 80s, they were, doing, they would actually had a program that if you got into it, they would train you to trade crude oil or oil products, things like that. So this was in Houston, Texas at the time, and I was, super fortunate to get my foot in the door there and get the opportunity to, be with Coastal and learn how to trade. So basically, they first set me off to, their refinery. They had a big refinery down in Corpus, Texas, and so set me down there for about 3 months, which was really great kind of learning experience to kind of get the grasp of, oil coming into the refining units and put it through the distillation towers and all that, producing gasoline things. So you just got the fundamentals of oil, and then eventually ended up in the tanker chartering department and doing operations, and then finally got into the oil trading side on the cargo desk, so crude oil cargo, foreign crude. And so super, great experience. They sent me out kind of not, too long after I'd been there to Singapore for a couple of years and traded the various Asian crudes and oil products out there. And then went to work for at the time, the largest oil trading company in the world. So this was back in the mid 80s. It was a Trans World, Fibro, Mark Rich. They were the 3 largest oil trading companies, just huge. And so just a really exciting experience there. So ended up going with Trans World and spent about 17 years there. They had their corporate offices were, in Bermuda for, tax reasons. And so spent 16 years there and ended up running the international trading desk out of Bermuda back in for about 10 years. So this is kind of a picture of me, back in the earlier days in Bermuda. At that time, we had just gotten, we had computers, but all of our trades and everything we did were pretty much we put on a blackboard. So it was just a real different way to trade. But we experienced a lot of trading, and that's where I first started experiencing the trading for options. So we started trading options. I remember back in 1987. I remember when we did our first option trade, the Wall Street guys would come in and they would actually teach you how to trade options. We didn't know anything about it. So set up the old Black-Scholes model, and the first thing we started doing was selling option premium, selling, premium on cargoes of crude oil. So it was great, but as long as the markets went your direction, but, learned on the fly. So hopefully I'll be able to pass along a few things today on the options side and let us get rolling. So the following workshop presentation today is purely for educational purposes. Any stocks, futures, or options mentioned does not constitute advice and should not be construed as a recommendation. So feel free to ask any questions. Now, if I miss your question, the GoToWebinar kind of scrolls down, so sometimes I miss it, so just put it back in again, but I'm happy to answer whatever questions and try to make this as interactive as we can. So, basically, I'd like to point out that trading is a business of probabilities, and to be a successful trader or investor, it really comes down to controlling your risk, and that's what's going to win the game in the long run. So knowing and better understanding how to manage and control your risk is going to make a really dramatic and positive difference in your trading or investment performance. And the best way to achieve this goal is through the use of options and option spreads. Now, because the unique option or pricing structure and capabilities that option spreads offer you, you can really better control the probabilities, and probabilities then can be, tilted way in your favors when we use options. Now, when using option spreads correctly, it's going to, help to provide you to find trading risk, really sharpen your risk, pinpoint exactly what it is. you can really lower your capital at risk, which is the thing I love about it. Plus also, with even the lower capital at risk, you can get greater leverage if you just know how to do the different option spreads and take advantage of them. And the other thing is options are the unmatched hedging advantage. So, options were originated, for hedging back on bonds and cattle and agricultural products. And now they become such a huge speculative part of, everyday trading, but they're still just a great way for, hedging against all kinds of different market events that can happen. Now, let's take a look here at step one is to understand, the first thing is understand how option pricing works. And so this, you need to do this in order to know how to, maximize your option profits based on the option Greeks. Now, when we're pricing the option, the value of the option, the most important factor comes down to understanding the concept of time and the volatility and the impact that these two components have on the price. Now, when we look at time value, we call that it's the extrinsic value of your option. So it's the premium that a rational investor or trader is going to be willing to pay over the current exercise value, that intrinsic value, based on its potential to increase in value before it expires. Now, it's this change in the value of your option based on time decay, we can actually then measure it using the Greek called theta. Now, when we look at time decay, it always works against buyers, but it's always going to benefit the seller of options. So when we look at the option and time value, we look at the Greek, what's called the option theta value, and this is what is either it's going to be a positive or negative value or kind of component or characteristic to your option. Now, all long options, so if you're long a call, long a put, they're going to have a negative theta value. So basically that indicates that they're going to lose value as expiration draws near. So it's that time decay is kicking in on that long put or long call. Now, the other side of that, though, is if you're short that call or short that put, they have a positive theta value. So that indicates that position is actually going to be gaining value as the expiration draws near. So that's what we want to take advantage of. We want to understand these components and then look to see and put them, in the favor and have them working for us. Now, the other major, option pricing component is volatility. And the implied volatility of the option is expressed as a percentage of the stock price. So this is basically indicating to kind of start out with a 1 standard deviation move over the duration of your option cycle. Now, in theory, a stock should end up within 1 standard deviation of its original price around 68.2% of the time during its option cycle. Now, this is theoretical, but it's what we're going to use for giving us a probability forecast of the security's price range. So this should always be part of the process that you use for selecting the highest probability price targets for any trade taken. And this is kind of the first step that we will take when we start to put on a trade. So we're going to want to know before we ever put on the trade or execute it, what is the probability forecast of price up or down, all right? So that's to help us set our targets. Now, the value of your option then is based on these components of time value times the implied volatility times the underlying security value, the intrinsic. And once we know these variables, then we're going to be ready to price out the option, know what the option premium should be, and then, take the trade. Now, here's a good little table to kind of illustrate how these components work. So here's like your time value component times the implied volatility times the intrinsic value or the underlying security value. We're going to leave this intrinsic at a constant of 1 to show how this flows through to give you your premium or your value of your option. And basically your option model is based on what they call the Black-Scholes model. So these are the components that will go into the model for it to give you your value of your option. So time value, implied volatility, the underlying security plus rho, which is the interest-free rate, which you don't really need to know about, and then time to expiration. So when we start out, every Thursday we're going to have a new weekly option series, and on that new series you're going to have 100% time when you first have that that series starts, right? Now I just plugged in the implied volatility here of 300 to show you how this affects the price of your option or the value of your option. So keeping this at a constant of 1, if we start out with 100% volatility or times the implied volatility of 300, we have an option value or premium of $300. Now, when you come into the market, after the weekend, at that time component still going against you, and you come in on a Monday, you're going to see that half that time decay is gone. So you're, cut that value in half as far as the time value of the option. So even if we spike up the implied volatility here, I put it up to 800, you can see it doesn't really raise the value of your option or the option premium very much. It only goes to about $400, right? Now, also think about if the implied volatility was to go down and now it's only at 200, well, then you can see your value of your option is only going to be $100 value. All right, so these are things that we want to be aware of, how they work, and then take advantage of them, or at least know what they're doing to our option. And at the end of the day, at the end of the option cycle, they're both at 0. So time goes to 0 and volatility goes to 0. And that's something that we can take advantage of, or at least know how it's affecting our options that we're, buying or selling. All right, so very important to understand these components and how they, act on the value of the option. Now, step 2 is the secret to income using options, and it's knowing how to sell time. So we can actually, trade time by selling time to take advantage of that option time decay or theta. And a really good kind of example is to think of an option kind of like a coupon that you get at a store, and you see it has to be redeemed by such expiration date or it's no longer valid. So you've got that expiration date, and you've got to use it, and that's exactly how an option is. So with the option theta, it's not going to remain stagnant. So it's actually going to increase as expiration draws near. So it really starts to accelerate as we get closer and closer to expiration day, and it actually decreases as the options go more in the money or out of the money. That's where you're starting to reduce your extrinsic value in the money or out of the money, okay? Now, in fact, the effects of your option theta decay really starts to soar when you get in the final 30 days to expiration, and that's when it really starts to kick in. And that's where we can really take advantage of, from the sell side or even from buy side, because we can buy options at a cheaper value due to that time decay, decaying the option price or premium. All right, so here's a really good example of time and how to kind of picture what it's doing to your option. So if we were to go out and buy an option, 120 to 90 days out, you're going to have very little time decay as you start out. So it's very, very small. But as you get closer in, so 30 days out, that's when it really starts to accelerate and starts to tail off. And at the end of the day, at the end of that option cycle, when you have 0 time left, that's where everything happens to go, option premiums go to 0 based on your time going to 0 and implied volatility. And then when we get the 30-day period, we've got the weekly options, or we even have daily options that we can take advantage of to take advantage of the accelerated time decay and volatility. So that's, kind of a good graphic example of time and how it really starts to tail off. And that's what you need to really understand what it's doing to your option if you're buying options or selling options. Now, step 3 is trading the probability. So it's kind of what I call the market maker secret. It's what they really don't want you to know. And it's all based on, option premium and the math and the probabilities of where option price will be at the end of the day. So when we look at broad markets, you'll probably, notice that, markets tend to have, 1 to 2 to 3 week kind of cycles, and we'll trade then in sideways channels a great deal of the time, maybe 70, 80% of the time. So it's based on the sideways price movement that out of the money option buyers are going to, really lose a lot, approximately about 70% of the time, or 6.8, 0.2% of the time, because of the out of the money options, going down in value because of time and volatility. Now, the market makers, they know these statistics, and therefore they're going to tend to trade from the sell side. So this is, the professional money. So we want to think like the market makers And it all comes down to the math and the math of probabilities. So option makers, our market makers, use the mathematical market probability statistics then for pricing out the movement of the option to its expiration using these, models, the Black-Scholes model. Now, some of the option platforms tweak it a little bit, but that's the pure model is based on the Black-Scholes. So by using the model, by knowing the probability of your underlying security stock finishing within a certain range, at expiration then becomes key to determining then what options you want to buy or sell, and then what option strategy to use. So these statistics forecast that how likely it is that your option will fall within a certain option series price range, either up or down, by its expiration. And this forecast is what we refer to as the implied move or the implied expected move of your stock. So this implied move then is the estimation of a one plus or minus one standard deviation move of your underlying security by its expiration based on that option cycle you're working with. So that's what we're going to deal with when we're trading options. We want to know first, starting out, I want to know what is the one standard deviation move up or down, and that's kind of the normalized move, and then we can start from there to kind of back into what option strategy we want to use based on these potential targets being hit. So when we look at selling an out of the money option, say one standard deviation out, you're basically going to start out theoretically with an 84% theoretical chance of winning. All right, so the way that comes about is based on the math of probabilities with your options. Now, when you have let's say you have a share, let's say you're long shares. Now, a share of stock will have an option delta like equivalent like 100. So, when we look at delta, we base it on the delta, the max delta being 100. Okay, like one option contract's equivalent to 100 shares. So if you had 100 shares and then you sold, let's say right here, see where that 520. This is a standard deviation bell curve. All right, so it shows distribution of price in this example. So we've got at the top of this curve, we've got the price at the money at $500. All right, so the expected implied move based on, let's say, the example option model is for this price XYZ trade at 500 could go up 4% or down 4% by expiration. Let's say that's within the next 10 days. Okay, so 10 days to expiration. So the option model then can give you this theoretical forecast based on the model of 4% up, that'd be $520, 4% down, that'd be 480. So that would be your implied expected move up or implied expected move down, and that's your one standard deviation price range. All right, so then starting there, that has basically a 16 delta. So roughly, the outside point will have a plus 16 delta or minus 16 delta. So I always look at a 16 or 20 delta is going to be that outside point. Okay, so now if you take that 16 delta and you sold that short strike, let's say the 520 right there with the 16 delta, then you're going to see the reciprocal of that is 84. Okay, so a couple ways that you can interpret this then. One is that if you sold that 520 strike, theoretically, there's an 84% probability that price will be below 520 at expiration. Or if you'd sold a 480 put, it'd be 84% probability below that. Or the other way you can look at it is there's a 16% chance that price would be in the money at 520, in the money at expiration. All right, so these are ways that we can then use this data, these statistics, to kind of give us an idea of probabilities of what that security might do. All right, so then if you go even further out, the tail right here to 2 standard deviations, which is around, a 5 delta, 3 to 5 delta, you can see there's a 95% probability that price would be below that range. All right, so that's how we're going to use it for trading options. So kind of what I always think about is one standard deviation is kind of the normalized price move. So that'd be your move up or move down, and that's where it could normally go to. Now, if you're thinking it could exceed that, then the probabilities get less and less of those price points being hit, outside of that kind of 1 standard deviation price range. All right, so this is kind of where we can start with, delta to kind of give us probability statistics of where price can go. Now, here's a good example of using your option delta and the probability. So here's a option chain. This example is like on Apple, and Apple here is trading, at $190. Okay. Now, in this option series, you can see this is like, for example, the 5 July series, 28 days to expiration. So if we look here, this is probability, that is probability out of the money, and that's your option delta. And so if we look at this example with Apple trading at $190, you can see here the delta showing you 0.52. So that's telling you that the delta is, basically is a flip of a coin. It's like 50-50. So, at the end of the option cycle, 28 days later, the Apple could be at $190 or above, or $190 below, and it's kind of 52% probability of that happening. So flipping a coin. Now you can see next to it is that probability out of money. So that's just telling you there's a 50% probability that the 190 strike price will be below it. Okay, so that's the other way you can look at it. Now, when you go further out, let's say down here to this 215 strike, you look over here to the delta, it shows you delta of 0.05. So there's your delta of like the 5% probability of being in the money at 215, at expiration, or here's your probability out of the money at 95% probability out of the money. So it's kind of like taking that delta of 1, your delta of 100, for 100 shares, and that delta of 5, you fill that point there, the probability out of the money is 95, okay? So these are, theoretical, but this is where we start with every trade to give us that theoretical probability. And this is what the market's looking at. So we want to use this information, and it's, free on most option platforms. So it's a really great tool to use to give yourself, statistics on probabilities of things happening, which is what, trading is all about. Now, by using this there when the market's freaked out, but look, just recovered and been trending back up. So we're still in a really strong, solid trend to the upside above that 8 exponential. So, we could easily pull back here. That'd just be a pullback to the 236 retracement from that low to high. All right, so not much of a pullback. Now, the 21 exponential is here, and that's kind of the mean reversion for a lot of these trends, the 20 period or 21 period. So, we could get a bigger pullback, but we'd still be in a very solid uptrend. That's on the macro, and momentum still positive to the upside. Now, we've been getting some weakness in market pause, kind of stalling out a little bit, though, when we break it down and we go down to the weekly time frame. So the long term is kind of like you're flying at 30,000 feet and you want to go down and see what else is going on. We can kind of go down with a lower altitude. If you come down here, you can start seeing that we're starting to get a shift in momentum. Momentum is starting to stall out. We've had a really strong uptrend here, and then momentum is starting to kind of stall out. See where we've been kind of going sideways to just grinding up. So right now we've had that purple arrow is a cycle reversal. So that's when we get stretched, overbought, like over 90 percentile, and then we get this indicator gives us a signal, an alert to potential change in the cycle. All right, so we've been getting a kind of a cluster of that. You can see right here, market goes sideways, we get another one kind of sideways, and we get a little pop up. And then this red arrow is momentum. This is a link to cycle 1, which you can see went negative. And again, we're starting to stall out. Now we just got this signal again. So this is showing a potential for more of a pullback based on the momentum slowing. So that could put us down. We came in on Friday, we hit the 50% the 50 simple moving average right here. The next big target down is going to be right in this range here, about 6,400, which would be 640 on the SPY. So we're seeing a little bit of slowdown in momentum here. So it's kind of a take caution and get hedged out, or look for some opportunities maybe on the short side. But again, the overall trend is still up, but we're getting that pause. And so now you can see the daily time frame, what's happened to us. We've come down and we hit that 50 simple moving average, which is a very important moving average for the markets. So you can see how we bounced straight back off of that on Friday. We pushed through it pretty hard, and then we bounced above it and closed above it on Friday. But now we are below that 21 exponential moving average. So we have broken trend, this medium-term trend. For the medium term, we've broken trend, and we had this island reversal. And a lot of times that our island exhaustion puts in as it's a topping pattern. So right now the markets have put in kind of a top for the next 2 to 3 weeks or maybe even longer. And we've tested this technical support here, which is a very key area of support. The first big one right there at that 50 simple moving average. So next week is going to be key to seeing if this 50 can hold. We'll probably retest it again. And what we want to do for this rally to continue, we want this 50 to hold. Now, we could get a bigger pullback and we're still okay condition. Here's your other big spike low is right here. So the next target down will be about a 655 right in here. All right, but right now that's where we are, and this would be on the SPY. I'll flip it over so you can see what that would be if you want to relate it to SPY. So SPY, you're looking at right here at 6, right there, 665, okay? And then the next target down, good support down here at 650. So that's what we're looking at. You can see how this 50 simple moving average has been just a really key moving average. Look at that, all right? So these are things I wanted to point out now, and then based on this, what are we going to do next? Okay, so let's take it from there. So step 5 then is you want to know when it's time to sell, and we're going to go through. I'm going to just kind of highlight here these option selling tools that I like to use, and these are included in the course package option 2 if you want to have these included, and these will be used in the course next Saturday. So this is my cycle reversal indicator and my extreme range band indicator. So I'll show you some examples of how these are used for knowing when it's time to sell or time to buy. So here's a current layout of these indicators right now. So this is the S&P 500 SPX on a weekly time frame, that long-term time frame right here. Now these are extreme range bands, which are based on average true range. And so a normal price move is to like the 2 ATR, that white band. That's kind of a normal price move. But when you get a really strong move, it'll pop out of that channel, and it's usually contained with that outer band, that 3 ATR. So it's a really good tool indicator for telling you when price is too stretched out, where you start getting potentially a mean reversion back to the 20 period moving averages, which is right there. And that's what we got last week. We got this first signal right here at the end of October, and then we had a negative momentum hit us first thing last week. So kind of that trend was broken on the momentum side, for the S&P and also the NASDAQ and the Russell. So we're kind of in a little bit of a damaged area here based on momentum. So that's a look there. And then I can pull this indicator up. I'll pull it up for you real quick here. Okay, here we are with the SPY, so you can kind of relate to that. Here it is on the weekly. So we got the cycle reversal. This was the end of October. Then we had this momentum shift down. Now, when this is concerning here, see this red arrow? That's momentum starting to go negative on cycle 1. So the last time we had that was right here. We went sideways, but you can look back here. This was back last year. You can see we had the cycle reversal, and then we had that negative momentum. The markets pulled back to the 21 exponential. This is the weekly, and then never could get going again. Just went sideways for 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, almost 2 months, and then finally broke down really hard. So this is, potential, what we could be looking for or looking at. And here's another one right here. So you can see a pullback. So we'll see. Now we've got a couple different, obviously, fundamental issues going on. The government shutdown. We've got NVIDIA coming up. So these could be catalysts for the markets to hold in here or pull back. So that's kind of where we are currently. And you can see here that on the daily, we've had this, a bigger pullback here. So you can see here we pull back to that 50 simple moving average, and you can see the next big target area down here is at 652. All right, so that's a look there. These are two really great tools that we'll be using for the course to help us, pick out sells and credit spreads and things like that. So here it is on the daily, the S&P 500 SPX, and we actually I set up a trade here on Thursday right there and had a move down here. I'll show you this in a minute, right into that 50, and that's where took some profit because that's a big area of support. So you kind of want to navigate, using your momentum indicators the way I trade it, and then use your support resistance for profit take, things like that to manage the trade. So I'll show you the credit spread that I did on this setup based off this sell signal here just in a minute. And then here's the QQQ using the same indicators. You can see it had a sell signal on momentum here. We had a momentum reversal, and then we had a negative momentum going negative here, and you can see what happened. It too came down to that 50 simple and bounced off, but it's below the 21. So we need to get back above here, back above this island. Needs to get really back above here to be able to go back up. If not, we'll probably get more testing, downside. So test the 50. Hopefully that holds and go from there. All right, so that's a look there. And then you can see here's the Russell 2000. Here's your weekly. We've had this thing. We had a cycle reversal right here. Then we had negative momentum this week, and we had a test down here on the weekly towards that 21 exponential. And you can see the actual signal right there. That's the weekly. And here's the daily. I thought I had the daily. Hold on, let me pull up the daily. So here's the Russell based on these extreme range bands and the momentum indicators that I've got linked in here. All right, so here's the daily. And, it's already broken below that 50. And it is broken the 21 as well. So this is the weaker of the three. And you can see where it currently is right down here in the support. I should have a fib levels in there. We can put that in later. Hold on one second. Yeah. So here we are. Here's the swing low to the swing high. You can see that weaker, and this is what we call a volatility squeeze. So the next really support is down to this 236, coming in right about here. That's a 100 period moving average. So you're looking at about 233 right in this area here. So next week, these will be, how to navigate the market. This will be what I'll be looking at, kind of this area here for the Russell at 233. Would like to see it get back above that 50. It really needs to get back above this area to be able to trend higher. All right, so that's the Russell. And then let's take a look where the QQQ, while we're doing this, where it needs to go. You can see it came down to the 50 simple, bounced off. It really needs to get back above this area here. This is an island gap exhaustion. See, it gapped up. And then on Monday, it broke that gap, so it was exhausted. And now it needs to get back above this area here for that continuation. So this is it'll probably chip around here. That's the 20 exponential 21. And so be looking at this to be tested again, the 600 area. Now, if that fails, then you're going to be, getting a move down pretty quick right to that area, that 590. Okay, so that's a quick look there, and then just kind of follow up there with the SPY. And SPY, similar, held at 50. It needs to get back above this area here, this island gap. You see it gapped up, broke back below it, needs to get back above this area. If not, we're gonna, probably retest this. Next area will be down here. All right, so just kind of wanted a quick review of that to show you kind of what the markets are looking like as far as potential upside or downside currently based on the market conditions. Okay. Now, you'll, again, just to point out, you'll get these two indicators, you know, with the course package if you do that option 2. Okay, so just to point that out as well. Now, step 6 then is, you know, selecting the right option income strategy. So, you know, again, one major goal for every trader really should be to select trades based on what's going to give you the most consistent positive return that also has low defined risk and not always the greatest return. So, you know, what I'm always preaching is, you know, we try to hit singles and doubles, then you're going to get occasionally that triple or the home run, which really spikes your equity curve, right? But we want to be very consistent and keep our risk in controlled and contained. So that's why we're hitting singles and doubles pretty much. So I always start out looking at the risk first and then back into what is the potential return on that risk. So we'll go through some things here, some different ways to trade, and I'll show you the different some of these different strategies. So to achieve this is then to know what the best option income strategies are out there available to you, understand how they work, and then select the one that's going to be best suited for your trading style and the market environment that you're trading. So things are always going to be changing. So it's important to understand that the option strategies that are there, how they work, and then, you know, select the one that's best suited for the market environment you're trading in or your style of trading. So we're going to go through and look at the vertical credit spread. We're going to look at the iron condor spread, the long condor spread, and what I call opportunistic hedging. And then we're going to look at another really cool trade strategy, the double vertical or a protective collar. All right, so these are, you know, selling kind of a hedging type of protective strategies that can combine the two things together. Okay, so the first one is your vertical credit spread. So this is a basic income, you know, option type strategy, and there are 3 kind of types of credit spreads that you can, you know, do or be used. So the first one is your bear call credit spread. Then there's the bull put credit spread, and the combination of the two together is what we call the long iron condor. All right, so let's take a look at these 3 and see how they work. Now, first one is the bear call credit spread, and this is, you know, going to be one that you'd want to use when you think the market's going to probably go down or lower, but it can make money over time even if the stock stays stagnant. So, you know, that's the great thing with the indicators. When we get a market really stretch and it starts to roll over, it can just go churn sideways and just, you know, really go nowhere. So that's a perfect environment for a credit spread. So you're selling out of the money, and even if the market churns sideways, you're collecting rent, you're getting money from the income from the, you know, theta decay. All right, so we'll go through an example or two to show you how that works. So good one for, you know, money over time if the market goes stagnant to down. And so this all it takes is selling one call, and at the same time you're buying another call in the same option series that has a higher strike to kind of cap that upside risk, so you're not short naked, you know, naked call. So, you know, if you're a more advanced trader and you know the risk, you could just sell a naked call. But remember, if the markets explode up, you've got unlimited upside risk, and you're not hedged out by, you know, owning something above it. So this is where credit spreads can really be helpful. Now, these are what we call a negative risk ratio trade or probability trades. Okay, so here's just a good example to kind of illustrate the risk reward ratio of these. So here's like if you're short this short strike right here. So you're short a call right there. That's the 120 strike right here. Okay, and then that we're going to say has a delta of 20. Okay, plus delta of 20. All right, so then to hedge it, so in order to not be naked short, so if the market goes straight up, you've got a lot of risk, we're going to buy a call above it, and this would be the 1030 strike. So we've got the 1020 to 1030, and that's your credit spread. Now you can see the spread width between that is $10, which is, you know, $10 is 1,000. So remember, one option contract's equivalent to 100 shares. So this would be a spread width of $1,000 wide. Now with this example, this brought in a credit of $200 right there. All right, so you've got $1,000 wide spread, you brought in a premium of $200. So that's your income or your profit, if you want to look at it that way. But look at your risk. Your risk is the difference between the $1,000 wide spread, the premium you brought in. So your risk is 800. So that's your margin you would have to put up. And if you look at this, this would be, if you, keep that full $200 at expiration, that's a 25% return. So that's about what you get, 25, 30% returns, on these credit spread type trade setups. Now, this is also then a negative risk ratio. So in this example, you're actually risking $4 to make $1. So you're risking $800 to make 200, okay? So that's what it looks like, but it's a probability trade, because if you sold the 20 delta, theoretically, you've got an 80% probability, right? Based on the options, the delta, you've got that 80% probability that price will be below that short strike of 1020 at expiration, or there's only a 20% probability or chance that the price will be in the money at expiration, okay? So that's what we call a probability trade. So you've got an 80% probability. So that's why you've got a negative risk ratio, because you're theoretically, there's a high probability that the price will be below that short strike. Now, here's one that I set up here, was one on Thursday on a credit spread. So this was a bear call credit spread based on the indicators that I just showed you. So this was the weekly, had a cycle reversal right there at the end of October, this last 2 weeks ago, the 27th, and then had negative momentum coming in on Monday. Okay, so momentum went negative. All right, so that's a really big indicator that, price can either go sideways or we could be getting more of a downside move. You can see the last time we had this cluster was right here. This was back at the end of the year 2024. And you can see we had a cycle reversal alert signal, but we had momentum here. And then you can see that sideways price action. So it went sideways. We looked at it for two months, right? So this is a perfect environment for credit spread. So, if you're selling an out of the money bear call credit spread up here and the market goes sideways, you're making money, or it could come off and be a bigger, quicker, profit gain. All right. So that's the beauty of, these indicators, and then taking advantage of what the market's giving you. In this example would be a credit spread. Okay, so then we come down here, and here was the daily. This was on Thursday. So set this up. I'll show you the trade set up on the credit spread. So right here we had cycle 2 also going negative right there, and we were starting to break down that 21 exponential right in here. So it was trading right in there and starting to break down. So sold a bear call credit spread right here. You can see what the short strike was 68.90. So when this was set up, I'll show you here in a minute, that was like a 17 delta on the short strike. All right, so here's the risk profile, what it looked like here. So this was on Thursday the 6th, and this was using the 17 November. That's next Friday's expiration. So it was about 10 days out. So sold, went out to the 17 delta short strike, and that at the time was about the 68.90 short strike right there, okay, in that series for expiration next Friday. And then bought above it, so it's a capped risk trade, the 68.95, $5 wide spread, 17 delta short strike. So going into that, you've got that theoretical probability of 100 minus your 17. So 83% probability trade, starting out, okay? Now, when I do these trades, I like to try to at least get $100 per spread. So that would, lock me into at least a 25% return. So below that, it's just, it's not enough return. So anyway, that's kind of the way I look at it. And so received $100 credit, okay? So then the risk is the difference, the $5 wide spread, $400 would be your risk. And so that there's your 25% return if you keep the full premium. But what I would typically will do based on the market condition, I'll either start taking profit at 50 to 80% of the credit received. So in this case, if you received $100, if it dropped down to 30, or 20, I'll start taking profits. So I'd have like a $70 profit or $80 profit. So the profits aren't huge, but these are probability trades. So you're just chipping away, high probability trade. And for a sideways price action market, when we get these first kind of rollovers in the market. So here was the risk profile, what that looked like on Friday. So this was, dropped down when the market was hitting down here at 60. That was the 50 simple moving average right there. That's when this thing was the best optimum profit right there. It dropped from 100 credit received. Now it's at 30 bucks. You can buy it back for 30. That gives you a profit of $70 per spread on that trade in one day. So 18% return. All right. So that's your probability trade and just a credit spread if you want to, take advantage of the kind of potential down or just sideways price action. So this market could keep bouncing around sideways and just kind of stay there for a while. And that's one way to play that kind of market. Now, the other one, credit spread, is your bull put credit spread. It's best used when you think the market's going to go up. So this can make money over time, even if if the stock stays stagnant to sideways and doesn't go up. But, if it goes up, you're going to make money on it quicker. So this is basically what you're doing here is you're selling a put. But to hedge that, you're going to also then be buying another put with a lower strike in the same option series. So you're not naked short the put. So if you're just naked short the put and the market keeps going down, you're going to be, hurting because you're going to be put to it and you'd be, owning shares or whatever it might be at a bad market price. So this is one way to make sure that you're capping your risk based on where you're buying the other put to cap that risk on the short, based on the short put that you're short. And again, this is going to have a negative risk ratio as well. So here's, an example of that. You can see here, this was kind of back on Apple risk profile. So this was selling the 149 put right here, short that put. Okay. This is a bullish type strategy. So shorting that put, but instead of just being naked short, and that was like a 20 delta, negative 20 delta, and then bought below it, the put here, the 144. So just not naked short. So short the 149, long the 144. It's a $5 wide spread. Okay. The premium received was $100 or $105 right there. So the risk is the difference, $5 wide spread less your premium received. So the risk is $395. So this would be, if you kept full premium, a 26% return, or a negative risk ratio, you're risking $3.76 to make $1. Okay. So that's kind of how you analyze and evaluate the trade and look at your, back into your potential profit return on your capital at risk. And so here's one on NVIDIA, and this is a good example of the extreme range bands. We had a big hard stretched move down right there, and it came down to that 3 ATR. And this is like a lot of times like a rubber band. It can just really kind of slingshot back, okay, like this. And so that's exactly what happened. And so then it came back up. So this was a perfect place right here to sell a bull put credit spread out of the market. So this was setting that up at about 1 standard deviation out of the market, selling that short put bull put credit spread. So here was a trade example. This was on NVIDIA, and it was trading at 99.66. And so sold the 84.80 bull put credit spread. So the 84 short strike, when this was done, that had that 20 delta of not negative 20 minus 20. So that's an 80% probability trade, okay, based on the delta of selling that 84 short strike put. All right, so that's the probability trade there. And then it, popped back up and it was trading at 124.87. And so that spread then, was covered back at a penny, or just let it expire and you make 95 bucks, keep the full spread, about a 30% return over that 11-day period. Or, you don't have to have it go up. It could have just, NVIDIA, if it just stays sideways, you're still going to make money as long as you're holding that trade. It doesn't break through the your support area that that you're looking at for your stop loss or defense target levels. Now, the next one is your iron condor credit spread. So this is a really great one because what it does, it's a combination of that bull put credit spread and the bear call credit spread. So you're going to get that additional premium. So if you think that the markets that you're trading is going to really, kind of trade sideways in a tight range between two strike areas and stagnate, this is a great strategy to use in order to take advantage of that sideways price action, let time decay go in your favor, volatility, things like that. So this is what we call the iron condor. So ideal for premium collectors who seek to minimize potential losses in the event the stock, goes outside of that range. So what it does, it's going to take advantage of the time decay and the volatility crush on your options into expiration while it's trading between that range in a tight range. So here's an example of this strategy on Tesla. And this was another one, the thing about this is you can leg in or leg out. So that makes it a really nice strategy to, add to your portfolio. So here's like your short, a bear call credit spread basically on the profile, and then you're short a bull put credit spread. So, you can leg in, leg out, or you can do it all at once. So the credit you receive, so let's say this is a $500 wide spread, right? And let's say you receive here, let's just say you get $50, I'll say $50 there for that bear call credit spread, you get $50 here. So you've got a full $100 of premium, right? And so then it's a $5 wide spread. So then your risk is $400. So that's how this can trade out. And so, or you might get, more, you might get 75 or whatever, but that's why it gives you that additional premium for your profit. And so, then you can leg out if the market starts to, move, looks like it's going to move up, you can just close out the bull put credit spread, or if it's going to move down, or move it up, I mean, you close out the call credit spread. If it's going to move down, close that out, or, leave it alone. So what you want to do on this trade is just, if you think it's just going to stagnate, then the best thing is just kind of leave it alone and have it expire between your two spreads, right? That's the easiest way. But if it looks like it's going to move, then you can leg in, leg out, things like that. So here's an example of one that we legged into on Tesla. And Tesla's a really good one because it's really liquid and big fat premiums that you can get. So here's one legging into an iron condor on Tesla. So it started out with this one, set up a bull put credit spread to start with. It had come down. You can see the kind of the market condition. It was trading down here and it pulled back. It looked like it was trying to push back up. So what we did on this one, we sold the first thing we legged into, we sold the bull put credit spread first, and then when it started moving up, then we completed the trade by selling the bear call credit spread to complete the iron condor. All right, so this is an example of that. So here was leg one. So set up the bull put credit spread. At that point in time, it was trading at 243, and it looked like it was starting to move back up. So we went out and sold the below this. We sold the 237.5, 235 bull put credit spread. The 237.5 strike, short strike, had a 20 delta. So that gave us, going in an 80% probability on that, just looking at the theoretical probability statistics. All right, so we were short that put here, the 237.5, and then long that put, the 235 to cap in case it went straight down. Right, so that caps that downside risk. And then it started pushing up, and so we brought in $60 here, and just that was the full premium credit brought in. And then when it started pushing up, then we added the other leg, the bear call credit spread, to complete the iron condor to bring in more premium. So then it started pushing up, and now it's trading at 253. So sold the 267.5 call, bought the 270 above that. That 267.5 had a 23 delta, so that just, a 77 probability trade there. Just kind of look at the statistics. So now we are short this call, right? The 267.5 long that call, okay, for $38. Now we put the two premiums together, and we've just completed an iron condor that looks like this, okay? So this is your two spreads. So we're short that call credit spread. We added that leg 2, you know, when it was moving up. We started with the bull put credit spread first, right there. We had a really wide spread right there, big range between the two short strikes, okay? So we had that short strike here. This was the 267.5 short strike, and then the bull put credit spread had the short strike way over here. So we had a really wide spread, which gave us a lot of leeway for this trade to work out. All right, so this brought in then a total of credit received was the 60 plus the 38. So we had a $98 credit, and then you just, you know, closed it out for a spread profit of 91. So 60% return on the capital that we had at risk. Okay, so here's the capital profile right here, so you can see what it was looking like. So here's the bull put credit spread side. Okay, we had that short delta of 20, and we brought in that 60 cents or whatever that was, and then we had the additional bear call credit spread here, brought in the additional premium. So we had a total of $98 credit brought in for the two credit spreads. And then the spread width was $2.50, so that gave us the potential profit, you know, to keep that $98, and that would be on the margin risk of 152. So it's a $250 wide spread, right? We've got a full premium of 98 brought in, right? So that gives us your spread at risk, your margin, so 252 less your 98. So that gives us our spread. The profit per spread margin was 152. Actually, this was 154, and that's how you just calculate what your then return is going to be on that based on your spread margin. Yeah, 152. All right. So then if you ended up making 98 on that spread margin 152, that's 64% return. So that's your typical very nice iron condor that you can leg in, out of, or if you don't know, you just put it all in at the same time. All right, so that's an example there. Now, this is this is one of our favorites at Power Cycle Trading, and so especially when we get into really higher volatility markets. Okay, this is the long condor spread. So this, not to be confused with the iron condor, because what this does is combining either a put debit spread or a call debit spread with the opposite of it, a credit spread. So in this example, this is one that we've done on Palantir. So with this one, you're long, this example, you're long a call debit spread, okay? Long a call, short a call, but then bringing in more premium, reducing the capital at risk, and also giving us a positive theta by selling another credit spread. We sold a call credit spread here. All right. So this is a condor, so different from the iron condor. Now, the iron condor would have been like this. We would have had a short credit spread and a short bull put credit spread. That's the iron condor. So your profit here is just your premium received. So just remember from that Tesla, your premium was like $98 and your risk was your margin of 152. So you had what we call a negative risk ratio, right? But when we do long condors, this is going to give us a positive risk ratio because we're going to get more potential profit from the debit spread side, but we're still going to have a positive theta because we sold an extra credit spread against it to bring in positive theta, plus reduce our capital at risk. So these are a great trade strategy to give you, 100. Usually I look for, 1.5 to 3 to 1. So here's the one that we did on Palantir, and so this was a move up. Wanted to keep the risk really tight, so we did this with the long condor, and so it was trading at 123, and then was in at the 13th, and 3 days later, out at 128.88 when the condor was expiring. So these are a great way to keep risk control and kind of shorter duration trades, but we have a risk control, and we also will give us a positive theta. So this was the trade setup, and we can leg into this, leg out, but this one we just did as a straight condor. So we bought the 125, 127 call debit spread. So that's kind of what you'd be looking at there. And then also at the same time, which you could leg it if you wanted, sold the 136, 138 bear call credit spread against it. So that does two things. First off, it reduces the cost of the debit spread cost side, okay, by selling the credit spread, but it also will give us some positive data. So if you just do a debit spread, or if you just go long calls or puts or even a debit spread, you're still going to have a negative theta decay. So by doing this, you're going to have a positive theta. So you can see here, we did this with a maximum risk of $72, right? So super low risk trade. And so it's we had $2 wide spread, 7 minus 125, so $200 wide spread. And the cost of the trade was 72 bucks. So then the potential profit, if we go out between our spreads, we'll make $128 a spread, but look at the risk. That's on a risk of 72. So we have 177% return, which is a positive risk ratio, right? So we have a positive return of, risking $1 to make $1.77 versus the negative risk ratio, of risking $3 or $4 to make $1, right? So that's the way you look at it to assess the risk. So these are a great strategy, for kind of higher volatility markets. And so here's what the risk profile looked like going out. It went right between our spreads, which was perfect. And so we had the spread set up for a debit cost of $72. Spread blew out to 200, the max range there. So that gave us our full profit of 128 bucks on that risk of 72, $177. And we had a positive theta on this trade. So that's a long condor, and we can do this with calls for an upside move or puts for a downside move. Now, the next thing is what I call the opportunistic hedging. So this is one that really is cool once you understand the verticals and how to use them. And then you think when you set up a trade, I'm always telling my members and stuff, let's think 2 or 3 steps ahead. So it's like you're playing cards or chess. So in this example, we had set up a long put debit spread on QQQ. And then when QQQ started to pull back, come off, we adjusted it to a long put condor, and we're able to do it into a free trade where we had 0 risk on the trade that we adjusted it to, being a long put condor. All right, so these are really great, and when markets are really moving, hard against you, down or up, these are types of trades that you can look to do. So, again, I call it opportunistic hedge trading management. So we had originally set this trade up QQQ on the 28th. It was trading at 365, and then it was breaking down real hard. So when it broke down real hard, we added a bull put credit spread to it, which recouped the full debit spread cost of the original trade one. All right, so it went 365, then when it was trading down here at around 354, 355, we added the bull put credit spread, and then it bounced back up. And we had a put condor on with 0 risk. So here it was the trade we originally set up right here. So it was breaking down that key 50% retracement area. So the first thing is always direction, your timing. So we did the put debit spread here. And then when it broke down real hard right here, then we added the bull put credit spread out of the money down here to convert this to a long put condor and 0 risk, because we recouped the full cost of our debit that we started with. All right, so here's like trade 1 was the original trade. On the 28th, we went long the 6th October, 364 put, short the 360, so $4 wide put debit spread, okay? So long a put, short a put, really nice put debit spread, cost us $121 on the spread, so $121 there. Now, if the market closed at below 360 or below on expiration date, the 28th, the 6th of October, this trade would have made $279. Okay, $4 wide spread less the cost. All right, it's a great return, 230% return. So, 2.3 to 1. We risk $1 to make $2.30. Now, but we were able to make this adjustment when it cratered down. Look what we did, and this did 2 things. It brought in premium to offset and take out that 121 that we had originally on. Plus, it gave us additional positive data. All right, so we had trade one, we had that bull put credit, the put debit spread here, and then we that cost us $1.21 right there, debit cost. Now, when the market traded down on the October 1st, it was traded at 354.53. We sold a bull put credit spread, sold the 354 put right here, and bought below that the 350 to cap that risk in case it kept going straight down. All right, so the original trade, we were long right here, the 364 put right there. Short the 360 right here, okay? So that's the original put debit spread. And then when it rolled down here to 354, we sold the bull put credit spread. Look, brought in $1.41. So that not only does that convert this to a free trade, but we actually did this and now had a credit. So if it went out in here, or if it went out above here, if it went out to either side, we'd still make 20 bucks. If it goes out in here, you make the full profit of $400, which is your spread width. All right, so 400 plus the credit receipt. So this went out right there, right in the middle, pretty much close to it. And so this was a max profit on this trade of $420 on zero risk. All right, so that's the really beauty of it. But again, you know, these are kind of what I call opportunistic hedging. And so these things pop up every now and then. That's why you have to think, you know, ahead 2 to 3 steps. And if it happens, then go for it and take advantage. All right, so that was a tray setup there. And now here's your double vertical and or a protective collar. And this is a really great strategy, especially kind of right now when we're in these market conditions where the markets have had a great move up and you're wanting to take advantage of the potential for a pullback by either setting up the double vertical, which can be a really great profit-making trade, or also a great way to hedge. So also referred to as a collar. So basically it's a strategy designed to protect your stock or a portfolio of stock from any major downside risk while still allowing the upside participation. So what it does, it's combining two option positions around your stock holdings, or it could be around a specific stock. So there are a lot of different ways we can do this. So first off, you know, you're buying a protected put then to establish a floor. So this is your, you know, this is a couple of different ways to do this. And in the course next weekend, I'll be showing you the different ways that you can do this, establish these puts based on delta, based on the risk profile of what you're trading. Okay, so there are a number of different ways to do this, but you're basically going to be buying a protective put, and then you're going to sell and finance that by selling a call above or selling a covered call that'll help finance the cost of the put while capping some of the upside. So this is what's called or known as a collar or a double vertical. So it collars your position. So balancing your protection, you know, with a very effective cost efficiency for doing it by financing it. So think about this, just kind of the fundamentals of it. So if your stock goes down, think about the value. So if you're short a call, let's say you're short a call up here, right? So you're short a call. So now if your stock goes down, so you're long a stock here, you're short a call up here, and then you're going to be long a put down here to cap the downside. So you're, you know, this is called a double vertical. You've got a vertical credit, you've got a short call, and you've got a long put, et cetera, or a collar. So you're collaring your security that's in the middle. So think about it. So if the market goes down, your stock goes down in value, right? But the short call that you're short would go down, allowing you to buy back that call at a cheaper price. So you're actually making profit on that short call. So that's going to help to offset the downside move if your stock goes down. Now, you know, a lot of times this would expire worthless, so you just keep the full premium. And remember, you sold the call short at a higher price than the stock that you own. Now, the other part of the trade is your value of your put. Now, if you're long that put below it, you're going to, when the market goes down, when it's a long put goes up in value. So how do you make money, in a market going down? With options, you can sell calls or you buy puts. So the two things happen. So the stock goes down in value, but you're going to get value from the call that you're short going down, and you're going to get value from that long put. So that's going to help to offset the downside move of your stock. Plus, where you set that put is going to cap any more downside risk to that security that you own or a portfolio that you can do the same thing with. So here's just an example of this trade, how it can work. So here in this example, Joe owns 500 shares of XYZ. Now he bought the shares for $40, okay? Now on the 22nd of August, in this example, the shares had moved up. He's long the shares at 40 bucks, but the market had moved up. Kind of think about the market that we're in now, and now it was at $45. So he wants to temporarily hedge that position due to the increase in the overall market uncertainty. So kind of similar to what we are going through right now, right? Now, so here's what he does. So he goes out. So this is on the 22nd, it's trading at 45. So he goes out and he buys 5 of the 26 September weekly puts on XYZ. Remember, one option contracts equivalent to 100 shares. He's got 500 shares at $40. So he goes out and he buys 5 of the puts. For those 5 puts, he bought those at a $39 strike. So he's long the shares here at 40. He's got a really tight put below it at 39. Okay, so he's really tight control there. The market is trading up here at 45 when he does this. So he's really good hedge right here. And then to finance it, he sells in the same option series 5 of the 49 calls above. Okay, so now he's short the calls here, 5 of those, long 5 of these, and he's hedged out his shares that he owns at 40. So he's locked in a really nice collar around that. So a lot of different ways you can do that. And then of course, I'll show you the way that you back into it to figure out where to put your put, where to put your short call, and how to manage it. So here's the cost in this example of Joe implementing this collar or double vertical. So he had long the 500 shares at 40. He bought the 39 strike on the put. He paid 90 cents. That was his cost, debit cost. But he brought in, selling a 49 call, he brought in $1.10. All right, so he's long the shares there. He sold that call way up there. He bought that put down here. And he's got a really great tight collar. Now the net then was he actually got this done for a credit of 20 cents per share. And you can do that, depending on where you set up your collar, finance it, etc. So look at his break even. So he's got 40 bucks per share, less that 20 cents. So now his break even is below that 40. It's now 30.98. That's it. It goes 39.88. That's his break even, and he's capped for anything below that. That's a great deal. Now his max profit though, he's going to give up any gain above that 49, but he's okay with that. He's okay. He was, going to probably sell the shares at 49 anyway. So he's happy at 49. If it does keep going up, he's capped his profit there. So here's his upside. So he's got those 5 contracts, remember, times 100 to the multiplier. And then he's got the 49 short strike. He brought in that 20 cents there, less the $40. That's his shares. So, go through the math. On those 5 contracts, if it went to 49, if it kept going, he's going to make 4,600 bucks, 23% return on his capital at risk of the $40 a share. Now his max loss though is capped on the downside below 39, right? So the same deal. So just a quick and dirty here, he's limited his downside risk to, in this example, $400 or 2% down. So potential for a 23% return up, capping his risk to the downside at 2% versus just, down to 0, right? If he was long those 40s and he just said get out. So just a great way to cap in and lock in the value of your shares, or even we could do it with a portfolio. So if you'd like to learn more on how to master these, kind of strategies for income, profits, and hedging, then please join me next Friday, not Friday, but next Saturday for the Master Market Income and Profit Defense course. Okay. So again, here today, if you want, depending on which package, it's $167 with that 15% discount. So you're going to get just, put in powercycletrading.com/special. Let me give you that link again. And you put that in, and then you put in that cell 15, and you'll get the 15% discount. So here's that real quick. And then we'll go through the package, all the different bonuses, the indicators, and any questions you have, and anything you want to look at, any other trades, etc. We'll take a look. And then sell 15, and then put that in, and then here's what you're going to get. So if you do course package 1 with the option 1, kind of to make it clear, course package 1 is just the course, not the alert service, okay? And then I've got just the basic package. Some members may already have some of the indicators or not want them, whatever, but just the raw basics here will be $167. So that's going to give you the course, which is live recorded, plus you're going to get 30-day trial membership to my trading club. You can start it when you want, after the course or whenever. And then if you decide to stay with me, I hope you do, it's $97 a month, or we have other packages, but here's the value of that. And then we're going to do that follow-up Q&A, which will probably be the Tuesday after the course on Monday. And then you'll get just another option tutorial on the option Greeks. I'm throwing that in, which is a really great tutorial on gamma, theta, delta, gamma, all that kind of stuff. All right, so just that's the value of this package is kind of the bare, but the main thing is just the course. Okay, so a lot of my clients, they may already have the indicators. So here's just the package there for the course. Okay, so that's what you're going to get. Now, if you want for just $32, which is, I don't know, is that a cup of coffee now or 2 cups of coffee at Starbucks? Just for another $32 to the 167. If you want everything, it's $199. Okay, so with this, we're going to use these indicators in the course, the cycle reversal indicator. Now, these are all on my website. You can go to the website, Power Cycle Trading. You'll see these indicators, the description, what they are, etc. They're $197. You're going to get my extreme range band, $197. You're going to get my option trading course, Make Money with Options. That's $197 on my Power Cycle Trading website. And then you're going to get my Fibonacci price target mapping course. This is something else we'll use for next Saturday. Price target mapping. You'll get that as an addition to the course, $297. 30-day trial membership, you get that, plus the Q&A, and plus the option tutorial. So you're going to get all these additions of $1,400 for just an extra $32. Okay, so great deal. I would obviously go with that one, but you may already have the indicators. So if that's the case, then just go with the 167. And that's basically 93% off. Now, then the only difference here is course package 2 will give you the alert service for my 5 different trading alerts that I send out for the next 4 months, plus 4 months to my trading club. And again, you can stop and start on your own when you want to go on business trips or vacation. So you're going to get everything in course package 1, which is $197, today $167. But for an extra $32, you can get this plus the alerts. Now with the alerts, I send out butterfly long condor trade setups, calendar diagonals. We've been doing a lot of those lately. We've been trending. Monthly pinning trades, butterfly and calendar, selective trades when there's a pin. Breakout reversals, these are credit spreads or debit spreads, and selective earnings trades. Okay, so that's what you'll get. Those are the 5 types of alerts that I may send out. And last week we had an earnings trade, and we did a calendar. We did, I think, 2 calendars. So, a lot of different things there. So here's just a breakdown of this package 2. And this is package 2, gives you the alerts, 5 different types that I send out for the next 4 months. Trading club, just the option 1, that's with the course and just a couple extras there. Today it's $507. And then if you want it with all of the with the indicators and all the bonuses for that extra $32. You can get it today for $5.39, and there is a 2-pay. So this is the 2 different setups there. So you get my 5 different alerts, 4 months, 8 to 12 different stocks or ETFs. The various alerts that I send out would be calendars, counter diagonals, butterflies, condors, penny trades, credit spreads, and earnings trades. And then when I do send out these trades, a lot of members just do their own thing, but I always send out a specific option trade to use that goes, that's suited for the trade. I do a setup video review of the trade at the end of the day, so you know kind of what the background on the trade, why it was done. Trades are listed in archive. Then you're going to get my access to my Q&As, weekly Q&As for the next 4 months, which are live and recorded. I do a daily video newsletter. You'll get that every day after the close for the next 4 months. And then access to my virtual trading room during the day from Wednesday through Friday, and 50% discounts on any software or courses on my website. You'll get a member's discount code, 50% off of everything. And so that's everything. And again, just kind of go through the summary, and then you will take questions, and I'll show you some of the indicators and stuff. But through yesterday, we've had 119 trades closed out, 79 winners, 16 break even, 24 losers, 80% winners. We've had, this last week was a real whippy week with the kind of the transition back and forth. We were up to about 85%, gave back a little bit, a few trades here, but these are very controlled, low risk types of trades that I sent out. And these are, again, unaudited, kind of just the summary. And so then from inception, when I started sending out the first alert, and then I've added different alerts to it since, but the first sent out was back in 2018, and we've had a really high winning percentage. I really try to keep that winning percentage as close to 80%, over 75, 80, preferably. Just keep high win rate. So we've had 951s close out, 677 winners, 70 break even, 203 winners, again unaudited, but that's kind of a summary of the results there. So if you do want the alerts, that's what you're going to be looking to get. And it's just going to be an additional, basically, it'll be 507 if you just want the course with a couple of extras. But if you do want everything together for an extra $32, it'll be $539 today. And there is that 2-pay if you want to break it down, for a 2-payment kind of installment. And again, go there to look to see if you've done anything in the past. Now, here was just a quick note that I wanted to pass on. This was from Pam. She said, just sending a quick note of thanks that you can maybe pass along to Larry for all the fabulous teaching through the years. Truly enjoyed learning from him, the other traders in the room. I don't think there's a better trader in the world when it comes to option spreads and the other ways to trade than Larry Gaines. So really appreciate that. Now here's kind of a summary breakdown of the course. So part 1, we'll start out with the option Greeks that are, important for selling options and credit spreads. So we're going to go through the Greeks in more detail there. How to use that delta trade probability, how to do all the Greeks, how they're used for these types of trades. We'll go through my option selling guidelines and rules, specific rules for these types of trades. The pricing the option, how that works, how that works with their volatility component. And then what we're going to use price target mapping. You get that course as an add-on, but we will be using the price target mapping kind of course in the trade setups that we'll be going over next Saturday to set up our profit targets and defense targets. So price target mapping is what we use for that. And then we're going to go through the best markets and time frames for the credit spreads. How far out do you go? Do you go a week out, 2 weeks out, how that works, how you back into that, and then how to incorporate and use the cycle reversal and extreme range band indicator for helping us signal when it's time to sell options, either selling calls for a downside maybe move, or getting set up for an upside move, retracement back up. So we're going to go through how those indicators are used. And then part 2, we're going to go through the 4 best selling strategies. So we're going to go through in great detail, step-by-step guidelines, on how, when to set up and defend a bear call credit spread, bull put credit spread, iron condor. So very, very good step-by-step guide on how and when and how to set those up and defend them. And then when would you use the bear call credit spread versus the bull versus the iron condor? Okay, what are the best market conditions for these credit spreads? So I'm going to show you the different kind of scenario setups that I like to use the credit spreads. And then, what time frames to use, how far out in time do you go? So what are the perfect time frames for entering and exiting credit spreads? And then we're going to go through the 5 kind of best rules for trading credit spreads and how to defend a credit spread. There are 5 different ways to defend. So we're going to go through the defensive strategies for a credit spread. If you've ever done credit spreads, you probably know that one can blow up all your trades. So we're going to go through how to defend credit spreads. And then we're going to go through section of the course will be just dedicated to the long condors, okay? So these are really great trade setups that we use, and these are not the iron condor. These are low capital, but a nice positive risk ratio type trade that delivers returns of 200% to 300%. That kind of risk reward outcome. No time decay. That's the other great thing. So this is just by understanding how to combine your vertical spreads to make the condor. So we're going to go through how that works, the rules that are established for doing this, and then also how we can adjust and defend a condor. So how we can adjust it, reduce the capital by adjusting it maybe to a broken wing condor or even a ratio condor. So we're going to go through how that's done in the course. So these are really great strategies for you to understand. And then part 3 will be just totally dedicated to hedging, okay? So in this one, we're going to go through just what I call kind of my progressions of hedging. How do you hedge the credit spread? How do you defend a core trading position? How, why, and when to use the condor as your hedging defense. And then 5 ways to hedge the credit spread. So this is this alone is worth the course right here. Five ways to protect and hedge a credit spread and still make money. And then the last part will go through how to do the double vertical, okay, or this protective collar for your stock or a portfolio. So if there's anything, you come in next weekend, if there's any specific stock, or if you have a portfolio you want to hedge, we'll go through in the course and I'll show you how to do it. So we'll step you through it and show you how to set it up. And so it's just going to be a great course. And again, this will be a really good one this time if you do want to start looking at some hedges, bring in whatever stock it is you want to hedge, or even if you have a portfolio, and I'll show you how to set that up. All right, so that's pretty much it. And then tool tricks and strategies. So you'll get an option selling library, and we'll go through how auto exercise works, assignment risk, all that. So it's a really extensive course. And here are just the bonuses real quick, and then any questions, please fire away. Okay, so there's your link there, powerstock.trading/special, and then sell 15, and you'll be good to go. Okay, so if you do want the bonus package 2, this comes with the cycle reversal indicator, and this is available for Thinkorswim, TradeStation, TradingView. Okay, I won't spend too much time on this. We kind of went through it, today with the workshop. And so it's a really great reversal tool that that I like to use to time entries into trades. And so it's a really great tool that we're going to use in the course. And if you do want this, it's available with the course. And then the other one that's available, option 2, will be the extreme range band. And this is a really great one to be using when we get major price movements where we're very stretched to extremes, when prices extended way too far from the mean. So with this indicator, it really helps to give you an alert signal for buying or selling exhaustion, and that is the first signal that a security is starting to reverse. So a really good tool for that, very accurate in signaling this in advance for your swing trades or longer term trades. So you'll get this tool available, and you can get if you have multiple platforms, you can have it for all. We have this Thinkorswim, TradeStation, eSignal, Ninja, Trader for that one. And then you're going to get extreme range bands. I'll show you how it works, how to set it up if you want in the course. And then you're going to get, make money with options. So this is a really nice intermediate course that you're going to get as part of your option 2 if you want this in addition. So this is on my website. This is $197 on my site. So it's going to go through the benefits of options versus stocks, insider tips for trading options, option basics, what the difference puts and calls, how option expiration works, and then covered calls. It's going to go through that strategy, how to do the income protective put strategy as well, and the vertical debit spread. So just another, just a nice option course to add to your, option trading library. So that's free there. And then this is just I use this for every trade, really. It's what I call my price target mapping. So this is, you're going to get this with option 2 as well. So this is and we're going to be using this in our course next weekend to set up our targets for profit take or defense targets. So this is, did this live, it's on demand, but it goes through the steps for target mapping, which is based on Fibonacci, based on trend line analysis, support resistance, the standard deviation and unusual option activity. So it's a 3-hour plus course, and 130-page course manual that you'll get with this course. And this is $227 on the website. And then you're going to get 30-day trial membership unless you do the package 2, which gives you the 4 months. But if you do package 1, you're going to get 30-day trial membership to the trading club. And so this gives you access to my virtual trading room, which is open 9:30 to 10:30 Wednesday through Friday. Now we start the week off on the Q&A, usually every Tuesday at 11 with the live and recorded Q&A, and then from Wednesday to Friday, you have access to the trading room. Do a daily video newsletter every day, showing you what the markets are doing every day, Monday through Friday. You'll get a trader's educational vault, part of your benefit there, and then 50% discounts on anything on my website, courses, and any other software. And this is one of my really good members, Jay, said reading books is fine, but seeing the actual option trade set up makes just a huge difference. And that's what you're going to really get a benefit from. And then we'll do a follow-up Q&A. This will be on Tuesday, dedicated to this course. And then another just option guide tutorial. This is just more on delta, gamma, theta, option pricing, standard deviation. So you'll get this 60-page guide with videos on that. So that'll come with either of the options there. And that's everything there. And then here are just a few trade setups if you want to see. This is what we've done recently. This was from one of my members, Dan. He said, you're very diligent and totally thorough with your analysis. This information was the foundation of the success of your alerts. I paid for my subscription with the first 4 trades I took with you when I was just learning how to trade options. Please feel free to share this with your other participants. So that was from Dan. And then Scott said, be the best investment that you'll ever make. Go with the elite package, great group of traders. Now, when I do send out alert, like I said, a lot of people that have my service, they just want the trades I send out. But I'll always give you an option trade if you want to use the option trade that I'll match with the trade alert. So it'll have the entry level, it'll give you the profit targets based on the price target mapping, what option series to use, stop loss levels and guidelines. And then I monitor the trade, from inception all the way to the close. I'm constantly updating you by the alerts. We use Telegram, so it's an instant alert text that comes out, and it's also a free app that you're going to be using called Telegram. And so the trades that are archived, so you can go back and review them. So really great, everything that I give you there. And then you're going to get that, and then I'll do a trade setup video review that day after the close, tell you a little bit more why I did the trade. Daily video newsletter that comes, so you'll have all this for the next 4 months with the trading club. You'll have access to weekly Q&As, live and recorded for the next 4 months, and access to the virtual trading room from 9:30 to 10:30, and then that should be 50% discounts in the Trader's Educational Vault. So here's a breakdown of the calendars. We've been doing a lot of these lately in this trending market. So Since starting this service back in 2019 through yesterday, we've had 381 trades closed out, 268 winners, 28 break even, 85 losers, run a 78% win rate here, unaudited. And these are really great trades. We've been doing a lot of these. This is kind of what it'll look like when I send out the text. This is kind of what they look like on Telegram. This is one that we did not too long ago on Dell. And so this was a long call counter diagonal that we adjusted into a call condor. So we got into this trade. It was trading at 150, and then we got out. That should be 158. So that's the wrong price there. But anyway, just kind of point out, you'll see when the alert's sent out, I'll put in the price that we're, I'll establish what we're doing. Here I said a Dell aggressive trade. I go through why it's aggressive, kind of tell you this basic setup where it is, why I'm setting it up, what the momentum looks like, et cetera, and then, what the trade is. So in this one, we set up using a diagonal to originally set the trade up. And then, through the trade, I'm managing the trade and sending out text about it. And then we ended up doing an adjustment here. You can see I won't spend a lot of time on this, but did a couple adjustments and ended up with this with a really big profitable trade. I'll show you here. So we got in right there, got out 2 days later, but this one was set up like this. This was set up as originally a call counter diagonal. So we were long that 31 October 150 call, and then we originally sold against it 24 October 152.5. Our cost in the trade was $330. This trade on this day on the 23rd, we set it up on the 22nd. It was trading 154. The next day it was here 153. So we were up here $87 per spread, 26% return, but it gets better. So what I try to do is if we get a good trending trade, we then adjust these things to either, typically a lot of times, to a call or put condor. So that's what we did with this one. We adjusted this to a long call condor when it was trading at 154. So this was sent out for all the members. And so we adjusted this. Now we were now into 152.5 call long, short to 155, debit spread side. And then we added to it the 165, 167. So this is what you're going to be learning in the course. And we had reduced this trade to zero risk. We first started out this trade with $330 of spread risk. And we adjusted this to a no risk trade with actually a $15 credit. So this trade ended up having the potential to make $265 on zero risk. So you can see that profile there, credit of 15. So $15 credit, potential to make $265. Now we didn't make that full profit, but we had a really nice profit. So went out and right there took our profit, what we had left right there. So it's trading here at 158.25, 150 to 128. So this spread, now we adjusted to that condor with a $15 credit. So we made 130 plus the 15 credit, $145 right there on zero risk. So that was one that we did not too long ago on Dell. Here was another one that was on Gilead. And this was something very similar. We did this starting out with a long calendar diagonal that we then adjusted this. This thing was just trending up like crazy. And then we ended up adjusting this and had fantastic profit on this trade. So let me just go through. That's the text that was sent out. And then, like I said, I'm constantly adjusting or updating you on the trade. So we had this trade entry right here. This was really perfect. We got in right there, breaking that 50, trended up, adjusted it here, took profit. And this was a really beautiful trade. So let me show you the progression of this. When we started out with this trade, it was a call calendar diagonal. We had a total risk of $284. On the 8th, this was trading at 118.27. At that point in time, that spread blew to 408, less our cost. So we were up $124, 43% return. But look, the next part of the trade, we adjusted this thing to a free trade. And so this was adjusted again into another long call condor. And that's what we're going to be covering a great deal in the course next Saturday. So adjusted this to the long call condor along the 119, 124 call debit spread here. And then we were sold the 127, 131 here. And by doing this adjustment based off the base trade, we adjusted it down to $30 credit. So here's our potential profit, 530 bucks, zero risk. So beautiful trade on that, Gilead. So this was an alert trade. And that's where she was. We were taking profit. 21st was trading here, $374. It blew out our credit, 30 bucks, $404 for spread on zero risk. So that's just another, example there. And here's one more, just another calendar that we did. This was on NEE, and this one is getting ready to set up again. So make sure if you're in the trading room, I'll be sending out this probably maybe alert on Monday if this happens, but NEE is starting to set up again. So there's one that we did on NEE. This was just a beautiful setup right there. We got it breaking that 50 and just beautiful, massive trend up. So we originally set this up as a call calendar diagonal and then adjusted this one into a call condor as well. So it was originally set up right here. And I'll just walk you through this one real quick. So it was trading at 72.65, and then that was the 24th. The next day we had some profit. The original spread was on 177, blew out to 269. So we're up 92, 52% return. But then it got better. So here's on the 1st of October now, it was trading right here at 78.55, right there. So now we had that spread, we had adjusted the spread. Now we're along the 75, short the 82, and we had adjusted cost of 115. Spread was now at 403. So $288 per spread, 250% return. Now I'm sending you these adjustments, so you know what to do. And then here it was on the 8th. Now it was trading up at, we adjusted this to a credit. So now it's trading up to $640 of spread on zero risk. So, when I'm sitting out, you're going to be getting these adjustments. I try to summarize it here, but there were so many different ones that we did. But this is what you'll be receiving, and then you can come in and ask questions if you have any on how these things work, whatever, in the trade room or at the Q&As. And then here's just a summary of the condors and butterflies, okay? So this is from, I started this service back in 2019 as well, and we've had 240 trades closed out, 172 winners, 20 break even, 48 losers, right about an 80% win rate. And these can be 2-1 up to, these can be 25-1. These are potentially huge winners sometimes. And so that's what you're going to get. Now, here's one that we had on Amazon. This is a long call condor. And, like I said, lately we've been doing more calendars and stuff and been adjusting those to condors, which have been great. But here's one that we had set up on Amazon. And so this was a really controlled risk trade we got into right there. And then had profit there and there. Two days, let's see, we got in 3 days later, we were taking profit. So in at 227.60, we were getting out on the 24th, is trading at 230. And then we also had profit the next day going into expiration. So here was the condor set up there. This was the 227 at 230 debit spread side, and then the 235, 237.5 credit spread side. So we had the spread, $2.50 wide spread. Cost of the trade was $105. The potential to make $145 on that risk. 138% return on that. We had done another adjustment on this, which we've moved up the short strike, so it kind of increased our debit cost, but here was still a really good trade. So it went out right here. And so we were up, went from 105 to 248. And so we were up 143 bucks on that risk of 105, 136% return and positive theta. So that was that. And then here's just a couple other, these are really fun. These are very, very selective. From time to time, we'll get these, penny trap trades. Here's one that we did on SPY. This was a long put butterfly penny trade. And I'll kind of flash through this here, but we set this one up looking for a potential pin. It was trading at 573.80. We were looking for a potential pin at 560. And so we pretty much nailed it for a pin. This was a return on our capital of over 1,000%. And that's why I call these lotto trades. So this was sent out. And you can see we set it up here, and then we were looking for a potential pin at 560. So we did this put butterfly. 565, 560 was our target. 560, 555. Cost of the trade, 39 bucks. $5 wide trade. Lesser cost, potential make 461. That would be over 1,000% return if we, nailed it on the pin, and got pretty close. So here it was right there going out. Now we're legging out, scaling out, put it that way. But at the very end of the day, this thing was trading right there, 560. So it went from 39 bucks to 456. So this was the very last part of the day, up over 1,000% in 4 days. That was a very cool trade on that risk of 39. And then here's just another one that amazes me. This is one that we did on Tesla for a pin up to 200. And so Tesla was trading here. We were looking for a potential target pin at 200. And it did go right to 200. This was amazing. So we did this 197, 200, 200, 202 and a half. So this was a $250 wide spread. Our cost on this trade, 12 bucks was a risk, $12. So that's why we had such a huge return, over 1,900% return. And this thing went out to the penny. This was amazing. Went out right there at expiration. Okay, so that's everything. So over 1,900% return on that. So that pretty much kind of covers everything. I hope that this was some really great stuff for everybody here, and that you can take this, start using it with you next week. And if not, make sure to join me next Saturday, and we're going to go through some great detail on how to use these strategies and the hedging and all that good stuff, and then go from there. So any last questions on any of this, or any trades or anything anybody wants to look at, let me know. I'd be happy to check things out for you. So there's your link there, and then remember, put in that SELL, SELL 15. Make sure it's small cap, and you're going to be good. All right, well, thank you, everybody. If no questions, have a great rest of your day. Make sure you come in here, come down, you can see what the packages are, and then you can, set your buy link up here, make it nice and easy, put in that SELL 15, and you're good to go. And then I'll see a bunch of you next week, or I'll see you back at the course next Saturday. So again, thanks so much for being here. Thanks, John. And thanks, Elizabeth. Have a great rest of your day, and have a great rest of your weekend. Ciao.